Our goal for this session is really to highlight 4 key themes that we think you'll find interesting. We're going to start with the US debt ceiling. It's picked up a lot of trade press, a lot of broader media, and it builds up a degree of a frenzy. Now it feels like the circus that comes to town. And to a certain extent, I think we'd all be forgiven for seeing it just as that. It's easy to get very complacent, making the assumption that actually a default of the US on their debts would be almost unimaginable. But that's the sort of media frenzy that was being churned up over the last few months. Now, what does any of this really mean? What the media are looking for, what we as investors are looking for, is that the US will be able to pass through both houses this increase in the debt ceiling to enable their economy to continue to function. Now, the repercussions of them not being able to do that are almost unimaginable, but one has to consider them. But what we did see in the US, and particularly within the Treasury market, so that's their own borrowing costs, which are quite often talked about as almost as a risk-free asset, is a huge spike around the time that a lot of this frenzy was being generated in those borrowing costs. So it's easy to get very, very technical about all of this, but you can see from the chart next to me, this big jump up that we saw when there was a bit of doubt as things got close to the wire of being able to pass through without the economy going into either default or going into some form of lockdown. Now, of course, everything was fine in the end, but that did have a ripple effect globally across financial markets and in particular fixed income markets, where we started to see that knock-on effect, much as we did last year within the UK and the gilt market. So that's been a key feature of the last few months. Now I'm going to hand over to my colleague Madhushree, who's going to talk about that in the context of the portfolio itself. Over to you, Madhushree.
Thanks, Tom. So the idea of the US, the world's biggest economy, defaulting is almost unimaginable, but it did create a lot of noise. These black swan events are difficult to predict, and over the short term, it can cause this huge dispersion in returns. So as investment professionals, we have to look through it and stick to our investment process, which provides us a sturdy framework to navigate uncertain times. You can see, as your time horizon increases, your dispersion of returns also narrows. And that increases the certainty of achieving your investment goals. The fact is that as a multi-asset investor, there are lots of tools available to us within the kit pack to help us navigate the different market conditions. And our portfolios have various layers of diversification. We're diversified across asset classes. So equities, which is a main source of capital wealth creation. Fixed income, which helps to preserve capital and limit volatility. Real assets and alternatives, which helps to protect against inflation, as well as providing reliable income streams. We also have the freedom to invest anywhere in the world, to be global, so we have a greater opportunity set, as well as having exposure to specific styles and strategies where we see value and strong fundamentals. Now, I understand this quilted slide is rather busy, but it is a strong illustration, and really what this captures is a sheer breadth of dispersion of returns across different asset classes over the different years. And what's interesting is that by having really an unsophisticated balanced portfolio, which is a mix of these assets, you can immediately start to see the impact of diversification. You can see it really helps smooth out some of those returns. It stays relatively stable. So ultimately, you don't want to put all your eggs in one basket, and that is the benefit of your portfolio being multi-asset class.